A Roth conversion ladder is one of the most discussed strategies in the FIRE community because it appears to solve a major early retirement problem. You may have accumulated most of your wealth inside a traditional 401k or traditional IRA. That was useful while working because contributions may have reduced taxable income, but after retiring early, the money can seem trapped behind age 59 and a half. Taking an ordinary early distribution may create income tax and an additional 10% federal penalty unless an exception applies. The Roth Conversion Ladder creates a planned pathway around that problem. Pre-tax retirement money is gradually converted into a Roth IRA. The taxable portion of each conversion is included in income during the conversion year. Then, after the applicable 5-tax-year waiting period, that converted principal may be generally withdrawn without the early distribution penalty. This does not make pre-tax money magically tax-free. The investor is still paying income tax. The strategy changes when the tax is paid, how much income is recognized each year, and when the converted principal becomes accessible. That distinction is important. A successful ladder is not one transaction. It is a multi-year tax and cash flow system. Each year creates another conversion rung. Each rung has its own waiting period, and the retiree must have another source of money available before the first rung becomes accessible. To understand the strategy, we need to follow one conversion from the employer plan all the way to the early retirement spending account.
The process normally begins after the investor leaves an employer. Pre-tax money may still be inside the former employer's 401k. Depending on the plan, the investor could leave it there, use a direct rollover into a traditional IRA, or preserve access through another strategy such as the Rule of 55. For the basic ladder example, assume the pre-tax 401k is transferred directly into a traditional IRA. A properly completed pre-tax rollover does not normally create current taxable income. The investor then converts a selected amount from the traditional IRA into a Roth IRA. That conversion is different from the rollover. The taxable portion of the conversion is added to income for that calendar year. Suppose $25,000 is converted in 2026. That amount becomes the first rung of the ladder. For a calendar year taxpayer, the conversion's 5-year period is treated as beginning on January 1, 2026, even when the transaction occurs later in the year. After 5 tax years, that rung reaches January 1, 2031. A conversion completed in 2027 creates a second rung that becomes available after its own waiting period, beginning in 2032. The same pattern continues each year. Convert today, pay the applicable tax, wait 5 tax years, use that converted principal later. The ladder must therefore begin before the money is needed. But this is where many explanations become dangerously oversimplified. There is not one universal Roth 5-year rule. There are several 5-year concepts, and confusing them can create unexpected taxes or penalties.
The phrase, the Roth 5-year rule, sounds as if one clock controls every Roth withdrawal. It does not. The first clock relates to qualified Roth IRA distributions. This clock generally begins on January 1st of the first tax year for which you made a Roth IRA contribution. Combined with age 59 and a half or another qualifying condition, it helps determine whether Roth IRA earnings may be withdrawn tax-free. The second clock applies to conversions. Each conversion has its own 5-year period for purposes of the early distribution penalty on taxable converted amounts. This is the clock that controls the basic Roth conversion ladder. A 2026 conversion has one clock. A 2027 conversion has another. A 2028 conversion creates another after that. The third concept involves designated Roth accounts inside employer plans, such as a Roth 401k. Those accounts may have their own qualified distribution history, which makes rollover planning more complicated than simply assuming every Roth account shares one date.
For FIRE investors, the key lesson is straightforward. Track every conversion year separately. Do not assume that opening one Roth IRA 5 years ago makes every new conversion immediately accessible. And do not assume that reaching the end of a conversion's waiting period automatically makes all account earnings tax-free. Converted principal and investment earnings follow different rules. This is why detailed records matter. The latter can provide access to converted principal, but the retiree still needs money to live on while those first conversions are waiting. That creates the most overlooked part of the strategy, the 5-year bridge. The first Roth conversion does not immediately fund the first year of retirement. It usually funds a later year. If the first conversion occurs in 2026, the basic ladder may not make that converted principal available until 2031. So what pays the bills from 2026 through 2030? That is the bridge problem. The bridge may come from a taxable brokerage account. The retiree can spend cash, withdraw cost basis, receive dividends, or realize capital gains. But those transactions may affect taxes and marketplace health insurance income. Cash reserves can provide another source. A high-yield savings account, treasury bills, or money market holdings may cover near-term spending without forcing stock sales during a market decline. Previously made regular Roth contributions may also be available because regular contributions generally come out before conversions and earnings under the Roth ordering rules. Older conversion rungs may help someone who started planning before officially retiring. Part-time work, consulting, or business income can reduce the amount withdrawn from investments. Other penalty exceptions may apply in specific circumstances, but they should not be assumed. The bridge must cover more than groceries and housing. It may also need to fund the income tax created by each annual conversion, health insurance premiums, unexpected expenses, and a market decline reserve. This is why retiring with exactly 5 years of expected spending can still be fragile. The retiree needs both living capital and tax planning flexibility. Once the bridge is funded, the next question becomes how much to convert each year. And that decision is not simply fill the lowest tax bracket. The annual conversion amount should be selected as part of a multi-year tax plan. Start by estimating all other income for the year. That may include wages from part-time work, interest, ordinary dividends, pension income, taxable Social Security benefits, and other ordinary income. Then add the taxable portion of the proposed Roth conversion. After applicable adjustments and deductions, the result determines how much taxable income falls into each federal tax bracket. The 2026 federal system still uses marginal rates ranging from 10% through 37%. A common strategy is to select an income ceiling and convert only the amount that fits below it. For example, an investor might target the top of a chosen marginal bracket, but the tax bracket is only one guardrail. A conversion can affect marketplace health insurance subsidies. It can interact with long-term capital gains and qualified dividends. It may trigger state income tax. At older ages, it can affect Medicare premiums through IRMA. Converting too little can leave a very large pre-tax balance for later years. That may produce larger required minimum distributions, less tax flexibility, and potentially higher future taxation. Converting too much can generate unnecessary current taxes and destroy valuable credits. The goal is not always to minimize this year's tax bill. It is to manage lifetime taxes while maintaining enough cash to pay the conversion tax without damaging the retirement portfolio. This is why the optimal conversion may change every year. And for early retirees purchasing marketplace health insurance, even a conversion that looks cheap inside the federal bracket can become expensive once health insurance subsidies are included. Health insurance can become the largest hidden cost of a Roth conversion ladder. Before Medicare eligibility, many early retirees purchase coverage through the Affordable Care Act marketplace. Marketplace premium tax credits are based on household income, using a version of modified adjusted gross income. That calculation begins with adjusted gross income and adds certain items, including tax-exempt interest, non-taxable Social Security benefits, and excluded foreign income. The taxable portion of a Roth conversion increases adjusted gross income. That means a conversion can reduce the premium tax credit even when the federal income tax rate on the conversion appears low. Under the general 2026 rules, premium tax credit eligibility once again has an upper limit tied to 400% of the federal poverty level. Household size also matters. This can create an income cliff. A conversion that moves household income slightly above the applicable limit may eliminate a subsidy that was worth thousands of dollars. Advance credits are also reconciled when the tax return is filed. If actual income is higher than the marketplace estimate, some excess advance credit may need to be repaid. The effective marginal cost of a conversion can therefore include more than federal and state income tax. It may include the loss of health insurance assistance. This does not mean conversions should be avoided. It means annual planning should combine the conversion amount, dividends, capital gains, tax-exempt interest, household size, and health insurance estimates. The tax bracket is only one dashboard, and the ACA is only one of several systems that can react when conversion income increases. A Roth conversion interacts with the rest of the tax return. The taxable conversion is ordinary income. As it fills the ordinary income brackets, it can also push long-term capital gains and qualified dividends into higher preferential rate ranges. Imagine an early retiree funding living expenses by selling appreciated assets from a taxable brokerage account. The capital gain may initially fall into a lower federal rate. Adding a large conversion can use more of the available income space and cause part of that gain to be taxed at a higher rate. State taxes create another layer. An investor planning to move from a high-tax state to a lower-tax state may care deeply about whether the conversion occurs before or after the move. The net investment income tax adds another interaction. A Roth conversion is generally not itself net investment income, but the higher modified adjusted gross income may cause more investment income to become exposed to the additional tax. Medicare IRMA matters later. Medicare generally uses income from 2 years earlier when determining certain Part B and Part D premium surcharges. A large conversion around age 63 could therefore increase Medicare costs around age 65. None of these issues automatically makes the conversion bad. The conversion may still reduce future required distributions or move income into a favorable year. But the real marginal cost must include every affected system. That is why a good FIRE plan models the entire tax picture, not just the number shown beside one tax bracket. And this is a useful point to reinforce the purpose of the channel before moving from strategy into execution. If you prefer early retirement analysis without tax-free income myths, spreadsheet fantasy, or one-size-fits-all conversion targets, subscribe to Boring Money Wins. A Roth Conversion Ladder can be powerful, but it is not a loophole that allows investors to ignore taxes, healthcare costs, or cash flow risk. It is a structured system that coordinates pretax accounts, a Roth IRA, taxable assets, annual conversions, and multiple 5-year clocks. If this video is helping you see the entire system instead of only the final withdrawal, click the like button. That helps YouTube recommend the video to more investors planning for financial independence and early retirement. The central principle is simple. Build a tax map, not a tax trick. Identify when earned income will stop. Fund the first 5 years. Estimate the conversion tax. Control marketplace MAGI. Track every rung, and maintain a backup plan for markets, legislation, and healthcare costs. Early retirement is not only an investment problem, it is a cash flow problem and a tax planning problem. Once the strategy is designed, execution becomes the next risk. A rollover completed incorrectly can trigger withholding. Taxes taken directly from the conversion reduce the amount entering the Roth IRA. Missing records can make future withdrawals difficult to defend. And because Roth conversions generally cannot be reversed, operational mistakes may be expensive. So let us walk through the process step by step. Before moving money, review the former employer plan, compare its fees, investment choices, withdrawal rules, and potential Rule of 55 access. Rolling everything into an IRA without checking those options can eliminate a useful alternative. Next, identify the required accounts. The investor may need a traditional IRA, a Roth IRA, and enough non-retirement cash to pay taxes and fund the bridge. When moving pre-tax 401k money, a direct rollover is usually cleaner than receiving the distribution personally. With a direct rollover, the plan sends the money to the receiving retirement account. When the check is paid to the participant, mandatory withholding and a 60-day rollover deadline may create additional complications. After the rollover, select the annual conversion amount. The money moves from the traditional IRA into the Roth IRA. The conversion should be coordinated with estimated tax payments or other withholding. When practical, paying the conversion tax from outside cash allows the full converted amount to reach the Roth account. Using retirement money for withholding reduces the conversion and may create early distribution consequences. After the year ends, verify the tax documents. These may include Form 1099-R, Form 5498, and Form 8606 when basis or other reporting makes it necessary. Finally, maintain a conversion ledger. Track the year, total amount, taxable portion, non-taxable portion, and first potential penalty-free access date. Documentation is not administrative decoration. It is part of the strategy, and the need for accurate records becomes even more important when the investor has previously made after-tax contributions to any traditional SEP or simple IRA. The simple ladder assumes the traditional IRA contains only pre-tax money. When after-tax IRA basis exists, the pro rata rule changes the calculation. The IRS generally looks across all traditional, SEP, and simple IRAs as one combined pool. The investor cannot normally point to one account and declare that only the after-tax dollars are being converted. The non-taxable percentage is calculated by comparing total after-tax basis with the total value of the aggregated IRAs. Suppose an investor has $10,000 of after-tax basis and $100,000 across all relevant IRAs. The non-taxable percentage is 10%. A $20,000 conversion would therefore be approximately $2,000 non-taxable and $18,000 taxable in this simplified example. The end-of-year IRA value also matters for the calculation. This is why old Forms 8606 should be located before executing a large conversion. Lost basis records may cause previously taxed money to be taxed again. Employer plans such as a 401k are generally not included in this IRA aggregation. Some employer plans may accept the rollover of pre-tax IRA money, potentially leaving the after-tax basis behind. But rules vary, and the transaction must be handled carefully. The main lesson is that after-tax IRA money requires accounting, not assumptions. The pro rata rule determines how the conversion is taxed. After the money reaches the Roth IRA, another set of rules determines which dollars are treated as withdrawn first. That ordering is crucial for a functioning ladder. When money leaves a Roth IRA, the investor does not simply select a label saying contributions, conversions, or earnings. Federal tax rules apply a specific ordering system. Regular Roth IRA contributions come out first. These are amounts that were previously contributed with after-tax money. They are generally treated as a return of contribution basis. After regular contributions are exhausted, conversions and certain rollover amounts come out. Conversions are generally ordered by year, with the oldest conversion distributed first. Within the same conversion year, taxable converted amounts are generally treated as distributed before non-taxable converted amounts. Earnings come out last. This matters because earnings may be taxable and subject to the early distribution penalty, unless the withdrawal is qualified or another exception applies. Consider a simplified Roth IRA containing $20,000 of regular contributions, $30,000 of mature conversions, and $10,000 of earnings. A $25,000 withdrawal would first use the $20,000 of regular contributions. The next $5,000 would come from conversion amounts. The earnings layer would not yet be reached. The ordering rules generally aggregate the owner's Roth IRAs. Opening a second Roth IRA does not allow the investor to create a separate withdrawal order. This is why the brokerage statement alone may not provide enough information. The investor must track historical contributions, conversions, and earnings. The latter can solve an account access problem, but it does not protect a retiree from selling investments during a severe market decline. That requires a separate sequence of returns plan. A Roth conversion ladder works best when markets cooperate. but early retirement plans must survive when they do not. Imagine retiring just before a major stock market decline. The taxable brokerage account loses value. Living expenses continue. Health insurance premiums still need to be paid, and the annual Roth conversion may create a tax bill even while the portfolio is falling. Selling depressed assets during the first years of retirement can permanently damage the portfolio. This is sequence of returns risk. The same average market return can produce very different outcomes depending on whether losses occur early or late. Several tools can reduce but not eliminate the risk. A cash reserve can fund spending without immediate stock sales. A treasury ladder can match known expenses over the first several years. Flexible spending can reduce withdrawals after poor market performance. Part-time income can create another source of cash. Diversification reduces dependence on one asset class. The conversion amount can also be dynamic. A market decline may create an opportunity to convert depressed assets, but only when the tax and cash plan supports it. A market rise may justify a different amount. Conversions also cannot generally be recharacterized. If an investor converts at a high market value, pays tax, and then watches the investment fall, the conversion cannot simply be undone under current rules. The latter solves an access problem. It does not solve every retirement risk. This is why a resilient FIRE plan normally includes more than one method of reaching retirement assets before age 59 and a half. The Roth Conversion Ladder is flexible, but it is not the only early access strategy. The Rule of 55 may allow penalty-free withdrawals from a qualifying employer plan after separating from service during or after the year the employee turns 55. It generally applies to that employer's plan, not automatically to an IRA. Rolling the plan into an IRA too quickly may eliminate that access route. Substantial equal periodic payments under Section 72T offer another path. The investor follows a calculated payment schedule that must generally continue for at least 5 years or until age 59 and a half, whichever is later. The strategy can provide earlier access, but the rules are rigid. Improper modification may trigger penalties and recapture consequences. A taxable brokerage account offers immediate flexibility. There is no retirement account age restriction, although dividends, interest, and realized gains can create taxes. Previously made regular Roth IRA contributions may also be available. New Roth contributions require eligible compensation and remain subject to annual contribution limits. For many FIRE investors, the strongest plan is a combination. Taxable assets can fund the bridge. The Roth ladder can gradually move pre-tax money. The Rule of 55 may support certain years. Cash reserves can protect against market declines, and 72T may serve a specific situation where the rigidity is acceptable. The best early retirement plan usually has more than one exit. With those alternatives understood, we can now assemble the complete decision framework for determining whether a Roth conversion ladder is actually ready to support retirement. Before depending on a Roth conversion ladder, answer 10 questions. First, when does earned income stop? The retirement year may contain wages, bonuses, or other compensation that reduces conversion room. Second, how much money is held in pre-tax accounts? A small pre-tax balance may not justify a complex ladder. Third, which assets will fund the first 5 years? The bridge must exist before the first rung is converted. Fourth, what is the annual spending requirement? Separate essential expenses, flexible spending, healthcare, and conversion taxes. Fifth, what annual conversion target fits the complete tax plan? Consider federal brackets, marketplace magi, capital gains, state taxes, and future required distributions. Sixth, has every conversion year been placed on a 5-year calendar? Seventh, does any after-tax IRA basis exist? Locate every available Form 8606. Eighth, are contributions, conversions, and earnings being tracked separately? Ninth, what is the market backup? Cash, treasury maturities, flexible spending, and alternative income can all improve resilience. 10th, what future risks could change the strategy? Required minimum distributions, Medicare IRMA, tax law changes and family circumstances all matter. The ladder may fit an investor with substantial pre-tax savings, a funded bridge, and enough control over annual income. It may be less useful when cash is needed immediately, current tax rates are already high, or conversion income would eliminate valuable health insurance assistance. A hybrid strategy may be stronger than relying on the ladder alone. The final verdict is simple. A Roth Conversion Ladder is not a tax-free early retirement hack. It is a multi-year tax and cash flow system. Fund the bridge, track every rung, control magi, maintain a backup plan, retire early carefully, convert deliberately, and let boring money win.